Hello everyone, welcome to the video. In this video, we are going to discuss a very interesting strategy called bull call spread. I'm going to show you a near zero loss strategy. I say near zero loss because there will be some element of losses possible in any trades that you take, and we are going to arrest it as much as we can. There are also very reasonable way to create a zero loss strategy, but then it involves very huge capital, and that's not really worth it, right? So what is this bull call spread? One of the things that you got to have is a market view. What is market going to do in next 1 month, or say next 2 months? You should have some sort of market outlook, and how you arrive at that is your own skill. Although we have done certain videos to explain how you can predict whether the market is heading north or south, and there are a lot of other videos that I have posted in short straddle videos, and also during the live stream that I have discussed extensively how to predict the trend. But having said that, you might have your own way of decoding market moves. So with that perspective, I wanted to share this strategy with you. This bull call spread is a strategy that works excellent in when the market is in the uptrend, right? If we are expecting the market to move higher, but not significantly too higher, okay, then this bull call spread is one strategy that can be employed superbly. Here we are seeing a chart of Nifty, right? And this is in days candle, 1 day. And I have drawn all the support levels from the historical past, and it has made a significant move on the upside. Very great progress, making higher highs and lower, higher lows, clearly establishing a trend that it is, trying to reach 23K, 24K, possibly by election time. Results are out. So now the question is that, having said, okay, I'm having a bullish view, I also wanted to know where I should be entering, right? And there is every possibility that we may do our analysis and say that the market is moving higher, but there are days where market goes against your own analysis and you are taken by surprise and lose money. So is there a way that we can protect the downside? Supposedly our analysis is upside, market is going upside, but unfortunately market is falling super fast. Can we protect ourselves? Yes, this is one strategy that will help us to ensure that we are not losing money. At the same time, if the market is going in our favor, we will be making a limited money. Although as a buyer, you wanted to make unlimited profits, time and again, market has shown us that we will lose money eventually because of the sudden spikes that we are witnessing in the recent times. One candle up, one candle down, and it can take off your capital. In order to avoid all this unnecessary stress and tension that we experience in the day-to-day basis, here is one strategy that you may want to consider. See, remember, I'm not a SEBI registered advisor. This is only for educational purpose. I'm just going to show you how you can initiate it, what are the things that you need to keep in mind, and how much of capital deployment that it might need. All of these things we can discuss. But should you go and employ your capital based on this video? No. You got to study it. If you feel like doing some sort of modification, some sort of enhancement to it, most welcome. You are free to do that. So with that note, let's get started. Say that the market, this is last year, November. This is where the rally started on the upside. And of course, if everybody knows that the market is going to go up, you would have taken calls and then waited indefinitely and then caught all this money, right? But then nobody can predict such moves. We are not some secret messiah, somebody who can, come and say that market will listen to me. Market surprises us all the time. So we cannot predict clearly that when to exit. Probably would have got an entry, but then where to exit, till where is the cap that I should wait? That part would have been a big challenge, I'm sure. So for education purpose, what I'm going to do is let's choose a month where there was an upside move, but then it's not very clear. If you see this February month, I'm taking it because it has a lot of swings, correct? If you see here, there is a clear trend, and if I show you a bull call spread, definitely I'll be winning. And this video looks like, okay, I have managed to do something and all. But then I wanted to really take a complicated a month. Here, if you see January end, and here is where is this? Okay, let's say January 25th and then 29th, right? And then next day it fell. This is probably a day that we will consider for this bull spread, because at that point in time, if you have it initiated, you will be thinking, okay, tomorrow is some sort of finance budgeting news is going to come, and then I can make some good money. Probably would have deployed some good money on the call side and lost eventually because there was a surprise fall. It didn't work out, right? It didn't work out the way that most people anticipated. So this would be a good area for us to analyze. But I promise that I have not done the back testing for this period yet. I just believe in going with the flow. But one thing I would say is that I would be creating a straddle for month-end contracts or next month-end contracts, not straddle, bull call spread. Any strategy that I'm going to discuss, it will be on the monthly expiry, not on the weekly expiry. Why? As a person who is learning the strategy, you should be focusing more on how the strategy unfolds with various movements and what happens over long time. Whether it is sustaining, the strategy is sustaining over longer time is what you should be testing, rather than whether it worked for 1 week or 2 weeks. That's immaterial. You want to make money once in the market, or you want to make money consistently. If you want to make money consistently, then do a longer time frame analysis. For that reasons, I'm going to choose a monthly contract or next month contract. In this video, I'm going to show probably Feb month contract. I anticipate that there should be some sort of upside moves coming, probably on 25th, let's say. Okay, I'm just choosing the date randomly. If you want, let's go for 25th. And here we are in Opstra. I'm choosing this simulator. And when I click on the strategies, it is listing you all the strategies that are there: bullish strategy, bearish, and non-directional. And here the strategy that we are going to see is called bull call spread, right? This bull call spread, if I choose, and what is the time frame that we are talking about? We wanted to check for January 25th, right? Start date is January 25th, and the contract, select the expiry. I wanted to select February month-end contract. I wanted to test. Okay, so 29th was the expiry. 25th, let's say that I have taken the position. Okay, and one of the things you should know is, what is a bull call spread? Bull call spread involves buying of one call of one call and selling of one call. Okay, the call can be, the buying call leg can be at the money or in the money. Sometimes people go like 1+1 OTM, and then selling of deep OTM, right? Like 2 strikes away, 3 strikes away. So this is a bull call spread. But is it a zero loss strategy? Absolutely not. It involves loss. It involves loss And here I am going to show you how you can make it into a zero loss strategy. Okay. Now I am going to delete these and then show you. So the expiry I have chosen is 29th, like I said earlier. The date on which I am going to take the position is 25th of January. And let's go to this option chain and check where the market was trading at that point. 21,450, almost 21,450. I will round it off. Okay, now my view is bullish, right? I am assuming that the market would go up, so I'm going to buy. But which expiry I am buying? 29th February. 21,450 was trading at 435 rupees. Okay, I am going to add one lot of this. Okay, and what you got to do is you got to move like 2 or 3 strikes away and then choose till where you wanted to capture. For example, I wanted to capture those 200 points, but at the same time, if the market goes down, I need some coverage. So I'm going to sell this contract 650, right? Add. So what we have done so far, we have added 21,450 call and sold 21,650 call, right? If the market is going in my direction, the maximum profit for one lot that I would be making is 5,000 rupees, and the maximum loss is again 5,000 rupees. So this is a 1:1 ratio. And you might be wondering, you said zero loss strategy. Where is zero loss? If the market goes down, I am losing money, right? Yes, if you're employing the theoretical bull call spread, you will be incurring losses, no doubts about that. So first, let's see what happens here, and then I will show you what can be done in order to make it into a zero loss strategy. And let's say, even I am thrilled now. I don't know what will happen, whether this will end in positive or negative. I am also going to learn along with you. I am choosing a simulation time of about 30 minutes. So the chart, this is a live market chart. You see the time is 25th January, 9:16 we have taken this position, let's say. Okay, market opened, we have taken this position. And for every half an hour, what happened, we are going to track through this simulation. So let's get started. I'm going to click on play. So here you see 300 rupees loss, 85 rupees. So as the time progresses, even though the market is moving plus or minus some 40, 50 points, we are not making or losing big. It's just there. So whenever you initiate a strategy like this, it's going to, because it is a buying plus writing combined, it will always have some sort of, uh, balance before it shows you a bigger loss or bigger profit. So you will not be seeing, when your position is well edged, you will neither see too much of no profit or loss unless you see a significant move happening. Luckily, here the market is going up in our favor significantly well. What is happening now? Oh, we are on 29th at 1,400 rupees, 1,800 rupees profits. Good. So since we have selected the expiry for 29th and then it's going in 30 minutes time frame, it's going to take a lot of time to see what's going to happen. So I would pause this for a while and then say that update me like one day, right? Because we got to see this is not the main strategy. I don't want to really waste much time on this. So let's go with one day, see what happens the next day. 1,700 rupees profit, 2,000 rupees. 5th of February now, 200 rupees, 1,006, 1,700. So comfortably, this strategy by itself, we have not seen any loss significantly. Like at least some 600 rupees, 700 rupees in the start when we initiated the position, it showed some loss. But technically, right after that, there was no loss. The moment it entered into the green territory, it is running in our favor. Only thing is that this is a limited risk and limited profit strategy. So you know you will be making only 5K if the trade goes right, or you will be losing only 5K. So it cannot be beyond that, right? So this is, in that sense, it's good. And we are here on that day. Probably if you have waited till the end of the day, this is at 10 a.m., you are making 5,200 rupees. Although max profit is showing 5,032, because it's a deep ITM, there will be some sort of more profit that you will be making. Although it theoretically it says max loss, max profit, there will be some variation in reality. And even if you go to the end of the day and to see what happened, we would witness probably by yeah, we made 5,100 rupees. Now this is the trade had gone in your favor, right? So you may be finding it good, but I wanted to really make sure that there is a little bit more that can be made here. And on the event of market going down, I don't want to lose anything. So that's some improvisation I wanted to do. And also I don't like the ratio 1:1. I wanted to change the ratio. If the trade goes right, I wanted to make more money than 5,000. But if it goes wrong, I don't want to lose anything uh, at all, like zero loss. So this is the improvisation I wanted to do. And let's see what can be done in this, right? I'm going to delete these. And then let's keep the same, expiry, everything. And I'm going to choose the strategy. Yeah, here I'm choosing bull call spread. Select the strike. Again, it's the same 21,450, right? And from option 10, otherwise I'll show you because I wanted to really explain you a few things over here. So 21,450, why is it showing so much? The date is fine, everything is fine. All right. So 21,450, this is the strike we have taken in for explaining the previous regular bull call spread. Now I'm going to show you a modification of the same. So I am here, there is no change. I'm going to buy one lot. Okay, this is same. Now, what is the premium I have paid to buy this? It's very high. I am going to lose 21,000 rupees. If the market is going down, I will be losing 21,785 rupees. Now, I don't want to lose that. But at the same time, I wanted to ensure I'm not making just 1:1. I wanted to make better. So how do I do that? I go here. See, remember, whenever we say a zero loss strategy, it always involves a writing. You may be saying that, sir, you are calling it zero loss strategy, and then I am a buyer. What can I do? You cannot establish a zero loss strategy without writing. If somebody is saying that you can do it, they are fooling you. Don't trust that person, right? So you got to do here. If I see in the previous example, we wrote 21,650, correct? And if the market goes up bullish, I will be making profit up to 21,650. After that, I will start losing my profits, or probably it will come to a stagnant point. It will not be much. Uh, but here, what I am suggesting is 435 rupees I have paid. Now, for me, it is only the calculation of this 435. Nothing else matters. Now, I can choose 235, 245 over here, right? And sell this one. Now I have sold to, where is that? 245 I have sold. And still 435 means 190 rupees still I am about to lose. I don't want to lose that. So 190 rupees is here. I am going to write this as well. So I'm doing a double sell equal to the value of the money that I paid. So 435 rupees is what I have paid, but I've also written for 245 and 190. If you add these together, it is 435 rupees, right? And you can see here, if the market goes down, I am in fact making 1,000 rupees, 1,600 rupees profit. Whatever happens, if the market crashes, corona comes, whatever happens, my downside is protected, safe. But there is always a catch, right? If the market goes up immediately, then I am in trouble, because the market goes immediately. One time only I will be making money in this, and these two will start appreciating like anything. So if it is moving too fast on the upside, again I am losing, right? And if it breaks beyond this point, like 20,000 in this case, 22,400 in this case, then I am again losing money. 22,400, if it breaks, I'm losing money. So where is zero loss in this, right? I need to do some sort of modification. How I can protect here is, there is some sort of improvisation you got to do. That is, you have done all these things in month-end contract, correct? And if you're doing one buying and one selling, the previously what margin would have required is hardly some 20,000 rupees. Now you are doing one buying and two selling. Probably this will cost you more than 1 lakh, right? And how do I bring the margin down? I have to buy some edge. I need to buy some edge. And how can I do that? I am going to the 2nd February. Oh, this is 2nd, not that. 1st February. This one I am going here. And then I will be starting to lose money once it crosses 21,400, correct? 22,400. So just I go here, simply 22,400, right? What is it trading? At 10 rupees, correct? So buy one lot of this, keep it. Correct? Now the payoff graph will be confusing you. Reason is, it is calendar spread now, because your one of the contract is expiring pretty soon, within like 6 days, and the other contracts, the main position is like 29 days away. It's unable to calculate and then show you correct values. Okay, so you actually buy this for hedging purpose only. This is not going to really be of much impact. And the only thing that you need to keep in mind is that you got, once the 1st of February comes, you got to close that and then go to the next week and then buy another edge. Likewise, you got to do it for 4 times, and probably how much money you will be losing on the upside is 40 rupees, correct? Because 4 weeks for 10 rupees that you have got, 40 rupees you would have lost. Some people don't want to lose this. They just don't buy this. They take the position as it is, and they take the position as it is. Oh, one moment. Now we have to go to 29. So the payoff, yeah, 29. Here we got to choose. Yeah. So some people, they say that okay, let the market first move and then we will take the edge. I'm also okay with that, because right now we are at 21,400. Nifty, will it move 1,000 points? Who knows? It can move, but then in general, on the upside, it doesn't move 1,000 points overnight in Nifty, right? So you can afford to take that risk. Although what is the big risk? If the market immediately moves, you are losing some 7,000 rupees. That's a black swan event. You can still square off. You can still square off booking this loss, which is acceptable. But you don't want to. You want to really tighten it at all time and then make it zero loss strategy. It's not possible. Okay. Downside, yes, we are making money. We are not losing. On the upside, if the market immediately blasts on the upside, we will start losing money. But still, you got time. Now, this is the strategy I wanted to talk about. And then I'm not going to include the edges here, because if you include the edges, then the graph becomes messy. We will not be able to keep track of what's happening in the market. And remember, it's only that below 10 rupees edges you just buy of 22,400, because that's where the break even is. You take the exactly at that look point, you take a edge. That's all. Probably you leave some 2-3 days. Saturday, Sunday gets over, and then Monday morning you see the same thing which was trading at 10 rupees, maybe trading at 4 rupees or something like that. People do that. People buy then because it allows us to release the margin. But if you don't take an edge, the margin will be higher. That is also there. Supposedly, if you buy the edge on at the very first day itself, yes, you are losing 10 rupees, but then your capital will be released by 50%. You need only 50,000 rupees to initiate it, right? If you don't take this edge, then you need 1 lakh capital. If people with good capital can afford to do that. Okay, so this is the strategy. Let's see how it works. Same thing. We are going with 1 day. First, let's start off with 30 minutes cycle, and then see how it plays out, and then we can increase the speed if need be. Okay, so 300 rupees profit, 267, 95, 50 rupees loss. $1,200 profit. We are going in half an hour time frame because 1st of February was the budget day, and I wanted to see what and all happened, because after the event it was a normal market. So during the event time, did it create us any trouble, or we were safe, is what I am trying to understand. So this is before budget. There was a strong rally, and then it is already giving a loss of close to 3,000 rupees, 2,700. So 4,000 rupees loss it was showing. So this is pre-budget day. That's why you see an extraordinary rally that day. If you remember, there was a massive rally. And still, it's not a big loss. We are like 3,000 rupees is okay, because we here look at the ratio. We are planning to make 20,000 rupees, correct? In the previous one, it was 1:1, 5,000 rupees, and then you get if the trade goes right, you win 5,000. If it goes wrong, you get you lose 5,000. Here, downside I'm not losing anything. Upside I'm making very good profit of 20,000. And if it goes too far away, then I will start to lose money. That's all, right? And that can be still managed. So we are going slow because this is the budget day. I want the budget day to get over, and after that we will go in 1 day time frame and see what happens. Now this is where I want to pause. You see, an even day got over, correct? An even day is somewhere the market is so volatile. The previous day was even more volatile than the even day itself. And we have initiated this position on 25th. So you must see, we have taken a strategy in the most complex environment and then seeing if we are losing. Yes, we are losing, but it's not that big a loss as compared to what we will be making if the trade goes right. If it is going right on the day of expiry, we are going to make 20,007 rupees. But what is the loss it is showing right now? 2,500 rupees. It's not even, if the win ratio is 1:10, right? Risk is 1 time, profit is at least 8 times, right? Yeah, 8 times. So let's keep going. I don't know whether this trade ended well or not, but still, I wanted to check what happened. The trade went well, it's good. So we are going in 1 day time frame now. It will be fast now. Okay, market rallying up fast, coming down 12. Good. So the profits reduced the previous day because market went up super fast. That's the reason. Perfect. So this is the last day, 9:31. It's almost there, 15,000 rupees. But then let's say usually on the expiry day, we got to close the position in the first half itself. I wouldn't advise anyone carrying it after 12:30. But worst case, let's say that we have waited till the end, what would have happened? I also don't know whether this trade is going to win or lose, but let's keep going and then see. So 11 o'clock, 11:30, 12, 17,000. This is good. You should take it. But 1 o'clock, 18,000. This is crazy. 2:30, 19K. I mean, 19,700. The max profit is 20K. Who wants to really wait? I mean, really, this is good, no? Let's check by the end of the day. Fantastic. We were able to make 20K, right? And I promise I didn't even do this checking before the video. Just I myself was like surprised to see that it gave maximum profit here. Just that I was expecting probably it would make some 10K to 15K ranges, but this is really a good one. Now, the question is, what if the market continued on the upside? So one of the things that we have not included here is you are keeping an edge, which means you would have bought some call options, correct? That is going to appreciate and then take care of uh, the losses that's going to come here. So it may not be really 20K. Probably for 4 weeks, I am taking, for 40 rupees I would have lost from the main profit. So 40 rupees into, say at that time, the lot size was 50, 50 quantities. Uh, 50 into 40 is 2000 rupees I can deduct, and then say that 18,000. Still, it's a good profit. Now, some of you may be saying, sir, why don't you do this in a weekly expiry? I can do it in a weekly expiry. The problem is there is a gamma effect. Like technically, it is saying that you can make 20,007 rupees, but then I made 20,045, correct? Similarly, the gamma effect, you will not be able to really predict what can be the loss. Sometimes it's crazy, it jumps like anything, and then you will be losing in the last minute, and it has a lot of uncertainty in the weekly expiry. That is one reason why I don't want to do it in weekly. Second thing is that you want to really understand how it works over longer time, and then see if the strategy is really working in all sort of market conditions. So let's play in the longer expiry. Sir, what about the other days? Like if I am initiating this and then do nothing for next 25 days or 30 days, um, am I not losing? Simple thing is that you go to sensible or do anything, add these three legs without edge also, see what is the margin required. Margin requirement will be less than 1.5 lakhs without the edges. With edges, it should be somewhere around 75,000 rupees or 80,000 rupees. Even let's say worst case, it is 1.5 lakhs. Okay, 1.5 lakhs you have put in, and then you are making 20,000 rupees. Now, what is the, like if you are taking 20,000, I am just doing a calculation, divided by 1,50,000 is 13% return, right? And how many trades this contains? Only 3 trades for entry and exit. If you're buying the edges, some 8 trades will come additionally because 8 weeks would have bought and sold. So that is all. Even the brokerages, if you all include together, another 1,000 rupees you would have lost. So 2,000 rupees for the edges, and even 1,000 rupees was to broker you have chosen also. 1,000 rupees it goes also. 17,000 rupees you have made. 17,000 is more than 10% of your deployed capital. Now tell me which strategy pays you 10% of your deployed capital over 1 month time, and you can go back in your portfolio, open and see how much money that you were able to make consistently, and were you even being profitable for 3 consecutive months? That's one question you got to ask yourself. If the answer is no, then this is an excellent thing to do. Go longer, go positionally. It is the best way to make money. And today, as we speak, this is 6th of May 2024. And I know everybody in the group, everywhere that I see, people are complaining about the random moves coming every now and then. The volatility is so crazy, unexpected moves, nothing gets respected. We don't have to worry about any of these things. This strategy has made money on budget month, right? And what worse can happen, right? And if something worse like Corona happens, we are protected on the downside. So upside, can the market move 1,000 points? Maybe election results, that time some surprises can happen. Other than that, how many occasions are there in which market has made upper freeze, and then how many instances market has made lower freeze? You do this study, and that is good enough for you to decide why this strategy should be working. People also do a lot of different other ratios. Probably so they will choose some 43 rupees strike, and then 43 rupees strike 10 times they will write. That also people do. But then it's all about money management, how much cash that you have. One writing only is costing so much, and then they will be making much bigger money, because if the market continues to go up, they will not be losing. They will not be making only 20,000. They will be making in lakhs, because they have so much of capital. It is rightful for them to make more money. And if we the number of times that you are splitting it, number of investment that you got to make, the number of investments that you make, the more money that you are able to generate. So that's the principle behind this bull call spread. This is a modified bull call spread. I am not going to claim this as a zero loss strategy as such. It is zero loss in most scenarios. And the flip side is, if the market goes super crazy on one direction on the upside, and then it is never stopping, yes, it can become a loss strategy. But that there also, if you have taken an edge, it is well protected and your risk can be capped, right? With that note, I will end this video. And if you like this video, please do share your views in the comments. And what is the next strategy that you would like to learn? Do post it in the comment section. I'll be more than happy to do a video on that. Thanks a lot.